Well, let's do another check of Treasury yields. We are seeing yields pushing higher on the back of key inflation data. The PCE index, the Fed's preferred inflation gauge, cooling off in December, falling below 3% for the first time since March 2021. Let's bring in Yahoo Finance's Jen Schonberger. Jen, you could argue that the Fed got the inflation print they wanted. Do we have any more clarity on the path ahead for rate cuts?
Hey, good morning, Kiko. That's right. The latest reading on the Fed's favored inflation gauge coming in weaker than expected, justifying the case for rate cuts sometime this year, but also leaving an open question as to how quickly the central bank could move to cut those rates. The so-called core personal consumption expenditures index, which excludes volatile food and energy prices, clocked in at 2.9% for the month of December. That's weaker than the estimate of 3% and down from the mid-4s earlier last year. More encouraging, if measured on a 6-month basis, core PCE clocked in at 1.9% for the second month in a row. This after we now have 2 consecutive quarters of core PCE inflation at or below the Fed's target based on third and fourth quarter GDP reports. Now, this latest reading on inflation has Wall Street pricing in a 46% chance that central bankers will lower rates at the meeting in March. That's down from about 56% a week ago. Fed officials have predicted 3 rate cuts this year, but policymakers have been pushing back on market expectations for loosening as early as March, cautioning they need to see more data to be sure. While inflation continues to fall as the Fed wants to see, hotter than expected economic growth could support an argument for the Fed holding rates at current levels past the March-May timeframe, for the fear that if you have higher economic growth, you could see inflation re-accelerate. That is not seemingly the case at this juncture, but officials want to be sure that inflation is going to sustainably remain at their 2% target.